Hello learners, and welcome to Manifested Publishers online learning revision classes. Today we are going to tackle the August 2022 question 2 in the financial reporting and analysis unit. The question was about group accounting, where one company had acquired another company to the tune of 70%. So our intention is to prepare consolidated financial statements in a setup where a subsidiary had been acquired. So straight to the question, that is question 2 of August 2022, financial reporting and analysis. Kuja Limited has owned 70% of Twende Limited's equity shares capital since 1st April 2017. The acquisition consideration consisted of cash amounting to 3,600,000 paid on 1st April 2017. The retained earnings balance of Twende Limited at the date of acquisition stood at 870 million shillings, and they had no other reserves. The draft financial statements for the two group of companies for the year ended at 1st March 2022 were set out below. There is the statement of profit or loss and other comprehensive income for the year ended at 1st March 2022 in columnar format for both Kuja Limited and Twende Limited, starting from revenue through to total comprehensive income for the year. We also have the statement of financial position as at 1st March 2022. Again, in columnar format, Kuja Limited and Twende Limited, from assets through to total equity and liabilities for the two companies. Additional information was set out as follows. Number 1, the fair value exercise carried out on 1st April 2017 concluded that the carrying amount of Twende Limited's net assets approximated their fair values, with the exception of an item of plant and equipment which had a carrying amount of 100 million below its fair value. At 1st April 2017, the plant and equipment had a remaining economic useful life of 10 years. Depreciation is to be charged to the cost of sales. Number 2, it is the group's policy to measure the non-controlling interest at fair value at the date of acquisition. The fair value of non-controlling interest in Twende Limited on 1st April 2017 was 1,370,000. Number 3, Kuja Group adopts revaluation model to measure its property, plant and equipment as permitted by IAS 16. Revaluation surplus reported by Twende Limited relates to the revaluations conducted in the post-acquisition period. Number 4, during the year ended at 1st March 2022, Twende Limited sold goods worth 200 million to Kuja Limited. Twende Limited reports a gross profit markup of 25% on all its sales. Kuja Limited still had 25% of these goods in its inventory as at 1st March 2022. Number 5, as at 1st March 2022, Twende Limited's records showed a receivable due from Kuja Limited of 140 million. Which corresponded with the balance in Kuja Limited's trade payables. 6. An impairment review conducted on 1st March 2022 revealed that goodwill arising on acquisition of Twende Limited was impaired by 10%. No impairment loss had been reported in prior years. Required: Group statement of profit or loss and other comprehensive income for the year ended 1st March 2022, 8 marks. Group statement of financial position as at 1st March 2022, 12 marks, and that totals to 20 marks for that particular question. So reading through this question, we've been informed from the onset that Kuja Limited acquired 70% of Twende Limited. That tells you that we are going to consolidate for a subsidiary. That is because if the holding company has acquired more than 50% of the subsidiary company, then that is referred to as a subsidiary. Something else to note is that this company was acquired on 1st April 2017, knowing very well that we are preparing financial statements as at 1st March 2022. This tells you that all the profits from 1st April 2017 moving forward up to that 1st March 2022 will be post-acquisition profits. In that tune again, it is clear that from 1st April 2017 till that 1st March 2022, it's a period of 5 years. That means that we are going to have the current year, which will be running from 1st April 2021 up to that 1st March 2022, and that is what we'll be preparing financial statements for. But still, we have other 4 years starting from 1st April 2017 up to that 1st March 2021, which are also considered to be post-acquisition periods. So straight to how the question should be implemented. And the first and important working will be the percentage of ownership. So to our workings, and we have working 1, percentage of ownership. Percentage of ownership. In our percentage of ownership, we have K Limited, this one that has acquired T Limited, and it is 70%. The conclusion is that this is a subsidiary, and therefore we are going to use the full consolidation method when preparing this consolidation. Of course, in relation to this, we could also bring in the trend of acquisition. This company was acquired here on 1st April 2017. 1st April 2017. Now the financial year is 1st April, the current financial year is 1st April 2021, which ends somewhere in 31st March, that 1st March 2022. So this one will be the current financial year. But the most important thing on what we've drawn here, all this from 1st April up to that 1st March is the post-acquisition period. Post-acquisition period. So the post-acquisition period, the entire segment from 1st April 2017 all the way to that 1st March is post-acquisition period. But remember, we are preparing financial statements from 1st April 2021 to that 1st March 2022. So this will help us when now we want to compute the retained earnings and we want to know the post-acquisition retained earnings. You don't just start on 1st April. We have post-acquisition earnings starting from 1st April, of course, 2017 on the far end. Working 2, we want to compute goodwill. So this is goodwill on acquisition, and we are going to use the full goodwill method. Why full goodwill method? We are going to use the full goodwill method because the examiner has given us the fair value of non-controlling interest. If you go to the additional information number 2, they are saying that it's the group's policy to measure the non-controlling interest at fair value at the date of acquisition. The fair value of non-controlling interest in 20 Limited on 1st April was estimated to be 1,370,000. So if it is the policy of the group to measure non-controlling interest at fair value, then it means that we are going to use full goodwill method so as to get the value of goodwill at the end of it all. So computation of goodwill using the full goodwill method. We have consideration transferred or paid, and the consideration paid was 3,600,000. We are going to use the 3,600,000, or simply put 3,600,000, truncating the other zeros. Add fair value of non-controlling interest, that is fair value of NCI, and the fair value of NCI is 1,370,000. 1,370,000. On that, we are going to less fair value of identifiable net assets. So that is fair value of identifiable net assets. The components of fair value of identifiable net assets are as follows. Of course, ordinary share capital, ordinary shares. Ordinary shares amounted to cost for the subsidiary 3,000. Ordinary shares are 3,000. There was no share premium. Revaluation. If you read through additional information number 3, Kuja Group adopts revaluation model to measure its PPE. And revaluation surplus reported by 20 Limited relates to revaluation conducted in the post-acquisition period. So the revaluation that has been presented up here in the financial statements only relates to post-acquisition periods. Here, we are interested in pre-acquisition revaluation. And that pre-acquisition revaluation is in additional information number 1, where the fair value exercise was carried out. And they are saying that the item of plant had a carrying amount of 100 million below its fair value. So 100 million below its fair value. That tells you that if carrying amount is less than the fair value, it is a revaluation gain. Or in short, the fair value exceeded the carrying amount. If the fair value exceeds the carrying amount, then that is a revaluation gain, and it constitutes our pre-acquisition revaluation, which is 100. That was 100. To continue, that was retained earnings, pre-acquisition retained earnings, and that is given in the onset of the question. And they said that the acquisition consideration consisted of cash amounting to 3,600,000 on 1st April 2017. The retained earnings as at that period, or as at that date, stood at 870. So we are going to use 870 as our retained earnings here. Then that will give you the total fair value of identifiable net assets, which is 3,000 plus 100 plus 870, 3970. This is 3970. Once you get the 3970, we calculate our goodwill, which is 3,600, the consideration, plus 1370, fair value of NCI, minus 3,970, and goodwill is 1,000 or 1 million. So we have the goodwill of 1 million or 1,000 goodwill. But this is goodwill before impairment. So we have impairment in additional information number 6, and they said an impairment review conducted on that 1st March 2022 revealed that goodwill arising on acquisition of 20 Limited was impaired by 10%. No impairment loss had been reported in prior years. So no impairment loss had been reported in prior years. So it means the impairment here only relates to the current year and not the prior years. Remember, we acquired this company on 1st April 2017, but the impairment that is being talked about is only for the current year. So it's going to affect the current year's financial statements or the current year's profits and not prior year's profits. Impairment has been given to be 10%. So you take 10% times 1,000. This gives you 100. So impairment is 100. If you deduct, you get 900. So this is goodwill to consolidated statement of financial position. So the goodwill that will be reported in the consolidated statement of financial position is 900. Then how do you account for impairment? Of course, with impairment of 100, debit the cost of sales, then you are going to credit. So as you debit the cost of sales, of course you've seen us already, we've credited goodwill, that one has already been credited, goodwill. Crediting goodwill means you deduct it, of course, from goodwill, and that has already happened. By just deducting it from goodwill, you get the crediting of goodwill. So what remains is to take the other balance of 100 to the cost of sales. So that means impairment, depreciation, all those things are going to be charged to the cost of sales. Working three, and in our working three, we want to move to fair value adjustment. We had something to do with fair value adjustment. So fair value adjustment, and we were told, of course, fair value adjustment is what we have as revaluation reserve on the far end. In additional information number 1, the fair value adjustment, the fair value was 100 more than the carrying amount. What that tells us is that apart from taking it to the computation of goodwill, we have to compute additional depreciation. So the fair value adjustment was 100. So that means 100 was the fair value, which was in excess of the carrying amount, which means that we compute additional depreciation on the same, and additional depreciation, reading through additional information number 1, it is that the plant had a remaining economic life of 10 years. So to calculate depreciation, it will be 100 divided by 10. So if you take 100 divided by 10 years, that one is going to give you 10. So 100 divided by 10 is 10. So depreciation is 10 per annum. For the current year, with 10, why? Because the farm was acquired on 1st April 2017. Now for 1st April 2017 all the way to that 1st March 2022, it's a total of 5 years. And total depreciation is going to be 10 times 5, which is 50. So that is depreciation of 5 years. It is 10 times 5, which is 50. But for the current year, you only take there 10 for the current financial statements, because the year was running from 1st April 2021 to that 1st March 2022. So with 10, you are going to debit the cost of sales. That means that depreciation is going to increase the cost of sales. Then we'll be crediting PPE, property, plant and equipment. So as you debit or take depreciation to the expenses and categorized as cost of sales, it is going to reduce the property, plant and equipment. For previous 4 years, and when we talk about previous 4 years, remember depreciation started occurring on 1st April 2017. Now from 1st April 2017 all the way to that 1st March 2021, that is 4 years. So you take 4 times 10, that is 4 times 10. We are going to debit previous year's retained earnings. We are going to debit previous year's retained earnings. So we could just abbreviate that. Retained earnings. Then you are going to credit again PPE with that amount. So you debit previous year's retained earnings, then you credit property, plant and equipment. So in total, property, plant and equipment is going to be charged with the depreciation of 50. That is 40, 4 times 10, which is 40. and we have the other 10, which means that PPE is going to reduce by 50. Our next working will be working 4. Working 4. During the year ended 31st March 2022, Twende Limited sold goods worth 200 million to Kuja Limited. Twende Limited reports a gross profit markup of 25% on all its sales. Kuja still held 25% of these goods in its inventory as at 31st March 2022. So that is intergroup sales, and for intergroup sales, they are eliminated in full, both from sales and also cost of sales. And if some goods were remaining in store, then it's supposed to compute for unrealized profit. Profit that has not been realized since some goods were still in store. So intergroup sales. Intergroup sales. So with the intergroup sales, debit with the intergroup sales, because the intergroup sales amounted to 200, debit sales, and you're going to credit cost of sales. You're going to credit cost of sales with the intergroup sales. On the same tune, compute unrealized profit. Compute unrealized profit, URP. Of course, for URP, it is computed both based on the goods that were left in store, and margin or markup has been given as 25. If markup is 25, convert that into a fraction, 25 divided by 100, which is 1 over 4. This is 25%, which is equal to 1 over 4. Margin is equal to 1 over 5. Margin is equal to 1 over 5. So the URP is equal to 200 times 1 over 5 times the amount of goods that were still in store. So the goods that were still in store were 25%. So with that, 200 divided by 5 times 0.25, 10. URP is 10. With the URP of 10, debit the cost of sales, and of course you are going to credit inventory. That could be put somewhere more clear. So with the 10, debit the cost of sales and credit closing inventory. Credit the closing inventory. That's how you treat the unrealized profit on the sale of goods. The last working, or the last additional information, is number 5. Twende Limited record showed a receivable due from Kuja Limited of shillings 140, which corresponded with a balance in Kuja Limited's trade payables. Now that one will be much more easier. You just deduct it from receivables and also you deduct it from payables. Now with this information, we can now be able to prepare consolidated financial statements. So start. Kuja Limited. Group statement of profit or loss. Group statement of profit or loss for the year ended. For the year ended at 1st March 2022. For the year ended at 1st March 2022. Million. Of course, with those, then we start sales. The first thing that we are going to start with is revenue or sales. So we start with the revenue. Revenue was put forward as follows: 5,100 for Kuja and 1920 for 20, and you less intergroup sales. Intergroup sales amounted to 200. So we are going to subtract 200 from intergroup sales. That is 5,100 plus 1920 minus 200. 6820 as our revenue. Cost of sales. Cost of sales 4050 for Kuja plus 1110 plus 1110, 4050 plus 1110. On the cost of sales, we add impairment. There was impairment of goodwill of 100 in our working 2, so impairment of 100. On the cost of sales again, we add additional depreciation on fair value adjustment that amounted to 10. On the cost of sales, again, there was also unrealized profit. Unrealized profit. Remember, it's assumed that closing inventory was overstated by unrealized profit. The overstatement of closing inventory on unrealized profit makes the cost of sales to be understated. So overstated closing inventory due to unrealized profit makes the cost of sales to be understated or undervalued, and therefore it's corrected by adding. So you add 10. Then finally, you deduct intergroup sales. Of course, the same one there, minus 200. So minus 200. In that will form our cost of sales. So that will be 4050 plus 1110 plus 100 plus 10 plus 10 minus 200, 50, 80, 50, 80. This gives us gross profit. Gross profit. Gross profit is 6820 minus 5080, 1740. 1740. On 1740, we less distribution costs. Distribution costs. This distribution costs have been given as 240 and 210. So this is 240 plus 210. 240 plus 210 is 450. 450. That is deducted. Administrative expenses. Administrative expenses. Now the administrative expenses are 480 and 230. 480 plus 230. 480 plus 230 is 710. 710. Then you get operating profit. Operating profit. So for operating profit, 1740 minus 450 minus 710, 580. 580, that's our operating profit. Once we have the operating profit, there is investment income. Investment income. The investment income is only for one, that is 160. Because now that is 160 plus 0, which is just 160. Finance costs. The finance cost amounted to 85 plus 125 plus 125, 210 Then income or profit before tax. Profit before tax, 580 plus 160 minus 210 is 530. 530. With 530 we have the income tax expense. Income tax expense. The income tax expense is 175 plus 125 plus 125. Before we get that, of course, the other one is 85 here plus 125. So 175 plus 125, 300. Then profit for the year. Profit for the year is 530 minus 300, which is 230. 230. Once we have the profit for the year, we also bring in other comprehensive income. Other comprehensive income. And the question said, in additional information number 3, Kuja adopts revaluation model to measure its PPE. Revaluation surplus reported by 20 relates to the revaluation conducted on post-acquisition period. So all the revaluations that we have here in the income statement for 20 is for post-acquisition period. Gain on revaluation of property. Gain on revaluation of property is gain on revaluation of property 180 plus 100. 180 plus 100 is 280. Total comprehensive income, and the total comprehensive income is 230 plus 280, 510. The total comprehensive income is 510. Total comprehensive income is 510. Once we have the total comprehensive income of 510, then it's important that we go back and analyze profit for the year of 230. Which one belongs to non-controlling interest and which one belongs to owners or parent? The other comprehensive income, which one belongs to non-controlling interest and which one belongs to the parent? So that's what we are going to analyze next in the continuation of the income statement. So up to that point, I could delete everything. Shillings million. Now on profit for the year, you must get what is attributable to non-controlling interest and what is attributable to owners or parent. Owners or parent. On the same team, on total comprehensive income, you must get what is attributable to NCI, attributable to non-controlling interest, and also what is attributable to owners or parent. Owners or parent, that way. So on that computation, we move to working 5. Working 5, profit attributable to NCI, profit attributable to non-controlling interest. 20 Limited's reported profit, 20 Limited profit for the year. 20 Limited's profit that was reported is 120. Now the following will be adjusted for: less impairment of goodwill, only if you used full goodwill method. If you used full goodwill method, then it means that you are going to deduct the impairment on goodwill. Impairment on goodwill amounted to 100, which we just rubbed here, 100. You also less additional depreciation, and additional depreciation for this year was 10. You also less 10 is on the other side on working 3, fair value adjustment. Then there was additional depreciation for this year. We have URP, and here is profit if the subsidiary made the sale. If subsidiary sold. If subsidiary sold, you must also less URP on closing inventory. It amounted to 10. To deduct this, 120 minus 100 minus 10 minus 10, that one is 0. So it means attributable to NCI is equal to 0 times 30%, which is equal to 0. 0 times 30%, the same as 0. So profit attributable to NCI is 0. If out of 230, the profit for the year, the one that is attributable to NCI is 0, then to owners or parent will be 230, and the amount here again will be 230, that way. So to NCI is 0, owners or parent is 230, the total is 230. Revaluation, so working 6, total comprehensive income, and we are going to talk about revaluation that is going to NCI, because total comprehensive income only includes revaluation. So revaluation to NCI, the total revaluation was 100 for 20. We are going to take 100 times 30%. So 100 times 30%, that gives you 30. That gives you 30. So attributable to NCI is 30. Of course, the total of comprehensive income was 510. The total of comprehensive income was 510. So what is attributable to owners or parent is 510 minus 30, which is 480. So attributable to parent or owners is 480. That is the complete consolidated statement of profit or loss for the group of companies Kuja Limited and its subsidiary Twende Limited. What follows is now the preparation of the consolidated statement of financial position, which follows up this one with its 12 marks. Consolidated or group statement of financial position. Group statement of financial position. Group statement of financial position as at 31st March 2022. Group statement of financial position as at 31st March 2022. The currency into millions. The first one is non-current assets. Non-current assets. The first of our non-current assets from what we've been given is property, plant, and equipment. So property, plant, and equipment. Property, plant, and equipment. And we have a cost of 5,300 for Kuja. Add that with 50-50 for 20. 50-50 for 20. And finally, we have to adjust for fair value adjustment. We have fair value adjustment of 100, and we also have a total depreciation, of course, 10 plus 40. Remember, we are crediting PPE, we are crediting PPE, so here it's 10, here it's 40, totaling to 50. So we'll be adding 100 here, which is the fair value adjustment, and then we'll be crediting it with the 50 here. So you add the fair value adjustment of 100, then you less 50, which is the additional depreciation. So 5,300 plus 50 plus 100 minus 50, 10,400. Property, plant, and equipment is 10,400. Investments. We have 4,500. 4,500. We deduct what was used in acquiring 20 Limited, and the consideration that was paid to acquire 20 Limited, the investment in the subsidiary, was 3,600. 3,600. If you take 4,500 minus 3,600, you get 900. 900. Goodwill on acquisition of the other company, we got goodwill after impairment to be 900. Our goodwill was working 2, amounted to 900. You sum them, this will be total non-current assets. Total non-current assets, and the total non-current assets are 10,400 plus 900 plus 900, 12,200. 12,200. Current assets. Current assets. The first one is inventory. Inventory has few adjustments, which among them includes the unrealized profit on the sale of goods. So inventory here is 2840 plus 1560 minus URP. We are crediting group inventory or closing inventory with 10. So with the 10. So that will give us 2840 plus 1560 minus 10, 4390. We have the trade receivables. We have 2480 for Kuja plus 1860 for 20 minus intercompany balances in additional information number 5, which amounted to 140. So they owed each other. What was a receivable here was a payable in the other company. So the 140 is to be deducted from both payables and receivables. So 2480 plus 1860 minus 140, 4,200. 4,200. Cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents amounted to 1780 plus the other one is 1030. 1780 plus 1030 plus 1030, 2810. 2810. Now if you first start by getting the totals of that, plus 4,200 plus 4390 plus 2810, that is 11,400, which of course will get the total assets. Once we have this, you can get the total assets. Total assets. Total asset will be non-current assets plus current assets. That is plus 12,200, 23,600. So this will be 23,600. So that is the total assets for Kuja Group in that consolidation. Equity and liabilities. Equity and liabilities. Equity and liabilities. On equity and liabilities, there is ordinary share capital. Ordinary share capital, which amounted to 5,000. You only take that one of the holding company and not the subsidiaries. The subsidiary one was used in the computation of goodwill. Share premium. Share premium 1,000. Share premium is 1,000. Revaluation reserve, we don't have it. So there is revaluation reserve. There is retained earnings. Retained earnings. And there is non-controlling interest. Non-controlling interest. All this requires workings, the three: revaluation reserve, retained earnings, and non-controlling interest. So from our working 6, we move to working 7. So working 7. Working 7. The first one is revaluation reserve. Revaluation reserve. On revaluation, in the statement of financial position of both companies, we have Kuja Limited, and Kuja Limited's revaluations amounted to 1,550. 1,550. Twende Limited, because what we own out of 700, remember they said that is an additional information number 3, all the revaluation that have been reported in the financial statements belong to the post-acquisition period. So it means we have 700, all of them are post-acquisition, times 70. That is what we own in this other company. So 700 times 70, that is 490, to give us 20 2040. 2040. So that is the revaluation that will be reported in the consolidated statement of financial position. Working 8, retained earnings. Retained earnings. Kuja Limited. Now Kuja Limited's retained earnings, as reported here, amounted to 4170. So that will be 4170, but you must deduct the profit for the year, which amounted to 230, because the profit for the year has been included in the consolidated statement of profit or loss, and therefore we will use profit attributable to owners or parent. So you take 4170 minus 230, 3940. 3940. Profit attributable to owners. Attributable to owners. And the profit attributable to owners from our consolidated statement of profit or loss amounted to 230. From our consolidated statement of profit or loss, the profit attributable to owners was 230. You also add 20 Limited's profit that were from 1st April 2017 just up to 31st March 2021, just before this financial year started. So other 20 Limited's post acquisition profit, post-acquisition profit. Now the computation of that is that we start with the profit given, 2530. That is the retained earnings in the statement of financial position for 20. From that, you deduct the profit for the year of 20, which was 120. You also deduct from the same thing, we are going to deduct the additional depreciation for the other 4 years. Remember, depreciation was 50, 10 was taken to the current financial year, but we have the other 40 that remained, which must also be deducted here. And again, on that, there is also profit that was there before we acquired it, that is pre-acquisition profit that was used in the computation of goodwill, which amounted to 870. 870. So this gives us 2530 minus 120 minus 40 for depreciation minus 870, which was pre-acquisition profit. The figure is 1,500. What we own is only 70 of that, and the answer is times 0.7, 1050. 1050. Now 1050 plus 230 plus 3940 gives us 5220. So 5220 will be the profit to be reported in the consolidated statement of financial position, 5220. Working 9, non-controlling interest. Non-controlling interest. On non-controlling interest, you start with fair value. Fair value of NCI. The fair value of NCI was given in additional information number 2 as 1370, so 1,370,000 fair value of NCI. Then on the same note, there is revaluation that you add. Revaluation. Which revaluation? You can see the revaluation reserve, there was some 70%. So the 30% for revaluation is the one that you are going to use. So that is 700 times 30. 700 times 30, and that will give us 700 times 30, 210. 210. 700 times 30 is 210. From that revaluation, we also have profits. Twende Limited, post-acquisition profits. Twende Limited post-acquisition profit, just like what we have up there. Exactly the same thing that we have up there. That would be 25, 30, minus 120, minus 40, minus 870. Minus 870. The answer is 1,500 times now 30. 1,500 times 30 times 0.3, 450. 450. Total is 1370 plus 210 plus 450, 2030. 2030. So clearly we have NCI of 2030, retained earnings of 5220, and revaluation of 2040. So this will be reported here. The revaluation of 2040, revaluation of 2040, retained earnings of 5220, and non-controlling interest of 2030. 2030. Now what follows is now to get the total shareholders funds. Total shareholders funds, as I clear this. Total shareholders funds. And the total shareholders funds are now 5,000 plus 1,000 plus 2040 plus 5220 plus 2030 plus 2030, giving you 15,290. 15,290, which takes us to non-current liabilities. Non-current liabilities. Non-current liabilities. On non-current liabilities, we have 10% loan notes. 10% loan notes. And we have deferred tax. Deferred tax. 10% loan notes amounted to 1,700 plus the other one of 1050. So 1,700 plus 1050. So 1,700 plus 1050 is 2,750. 2,750. Deferred tax. Deferred tax 740 plus 570. 740 plus 570, 1310. 1310. Current liabilities. Current liabilities. Our current liabilities, there is trade payable. And for trade payable, 2340 plus 2340 plus 1300, not forgetting intergroup balances, what they owed each other, the same amount that we deducted from receivables, which is 140. 140. So 2340 plus 1300 minus 140, that 500. That 500. Current tax. The current tax was 400 and 350. So 400 plus 350. This is 750, which gives us total equity. Total equity and liabilities. So total equities and liabilities, 3,500 plus 750 plus 1310 plus 2,750 plus 15,290 is 23,600. 23,600. So the total assets are the same as the total equity and liabilities, which means that our consolidated statement of financial position has balanced, and that is what was required of you as a student by your examiner. Thank you. See you in our next revision class. My name is Nicholas Sikali.